All right, let's jump right into this. Welcome to this explainer, where we're tackling what is, honestly, the single most massive economic reform in India since independence. I'm talking about the Goods and Services Tax, or GST. Look, whether you're running a startup, studying business, or you're just staring at your restaurant receipt wondering what all those acronyms mean, getting a grip on GST is absolutely crucial. So today, we're going to break down this giant, somewhat intimidating system piece by piece.
And to really get why this matters so much, you just have to look at the sheer scale of it. 1.87 lakh crore rupees. That is a staggering number. And that's the GST revenue collected in just one single month, April 2024. The economic impact here is literally monumental. We are talking about the absolute financial backbone of the modern Indian economy.
So to demystify a machine this big, here's our game plan for this explainer. 1. The GST revolution. 2. Types of GST explained. 3. The power of ITC. 4. Registration and compliance rules. And 5. Some real-world GST math. Okay, Section 1. The GST revolution, solving the tax chaos. You have to understand, before GST, doing business in India meant navigating an absolute nightmare of 17 different, overlapping central and state taxes. We're talking excise duty, service tax, VAT, octroi. It was just total chaos. And the worst part? Taxes were cascading. You were literally paying tax on top of tax. GST came in and wiped out that whole tangled web, replacing it with a single, streamlined framework. One nation, one tax, featuring a seamless flow of credit. A real game changer. But, a transformation this massive, it definitely does not happen overnight. The seed was actually planted way back in the year 2000 when Prime Minister Vajpayee set up an empowered committee. Then in 2006, the initial rollout target was announced. It took years of intense political maneuvering to finally introduce the bill in 2014, which paved the way for the 101st Constitutional Amendment in 2016. And then finally, at the stroke of midnight on July 1, 2017, the whole shebang officially went live across India. Now, let's be real. Every giant reform has its pros and cons, right? Let's look at this from the perspective of an everyday small business owner, like, say, someone running a neighborhood kirana shop. On the plus side, GST brilliantly fixes that cascading tax problem, which actually saves about 2 to 4% on product costs. It creates completely uniform rates across all 28 states, and according to the IMF, it gives a nice boost to the GDP. But on the flip side, the challenges are real. The compliance burden, filing multiple returns, really overwhelmed a lot of folks initially. And the high-tech dependency, that's a huge hurdle for rural traders who might struggle with digital literacy. Plus, things like petroleum and alcohol are excluded, meaning the system still isn't 100% comprehensive. Moving right along to Section 2, Types of GST Explained, the dual model. Okay, before we go any further, there's one crucial concept you have to grasp. It's the magic word of GST, supply. This is the ultimate taxable event. It's not just regular sales. We're talking transfers, barter, exchange, licensing, renting, all of it. But, and this is a big but, it needs two specific things. It must be made for a consideration, meaning money or some value changes hands, and it has to be in the course of business. So if you sell your old laptop to your buddy, that's not in the course of business, so no GST applies. Simple as that. So when a taxable supply does happen, India uses this really unique dual GST model. Basically, both the center and the states need their slice of the pie, so they levy taxes at the exact same time. If a transaction stays within state lines, like a Mumbai seller dealing with a Mumbai buyer, it's an intrastate supply. Both the center and the state get a cut through CGST and SGST. But if the goods cross state borders, say Delhi to Mumbai, that triggers IGST, or Integrated GST, which the center collects. And lastly, UTGST is basically just SGST, but for union territories that don't have their own legislature, like Chandigarh. To figure out the actual math, India uses a multi-tier rate structure. The slabs are 0, 5, 12, 18, and 28%. And if we look at the 2023 to 2024 fiscal year, that 18% standard slab, that is the absolute workhorse. It covers most services, banking, IT, and capital goods. And it pulled in a whopping 45% of all GST revenue. The 28% slab, which is essentially a luxury and sin tax, brings in about a quarter of the revenue, even though it applies to far fewer things like cars and aerated drinks. All right, Section 3, the power of ITC, the engine of GST. Listen, input tax credit, or ITC, is the beating heart of this entire system. Without it, the whole thing falls apart. Simply put, the tax you pay on your inputs can be used to reduce the tax you owe on your outputs. Think of it like a discount coupon for the taxes you've already paid. If you pay 900 rupees in GST buying raw materials and later collect 1,800 rupees in GST when selling your final product, you don't hand over that full 1,800 to the government. You cash in your 900 rupee credit and only pay the difference. That right there is how you prevent a tax-on-tax situation. Let's actually trace this across a supply chain so you can see the magic happen. Step 1, the raw material supplier pays 180 rupees in GST. Step 2, the manufacturer buys that material, adds their value, and now owes 360 rupees in tax. But wait, they claim that 180 rupees as ITC, meaning they only pay the remaining 180 out of their own pocket. Step 3, the wholesaler does the exact same thing, utilizing the manufacturer's tax as their credit. Finally, step 4, the product reaches the final consumer. Now the consumer can't claim ITC because they aren't making a business supply. So the ultimate burden of the total 720 rupees of accumulated tax lands entirely on them. It is a brilliantly self-policing chain of value addition. Next up, Section 4, Registration and Compliance Rules, Joining the System. So who actually has to sign up for all this? Well, not every tiny operation needs to register. In standard states, you only hit the mandatory threshold if your total turnover crosses 40 lakhs for goods or 20 lakhs for services. But, always a but, there are exceptions. If you sell across state lines or you sell on e-commerce platforms like Amazon, you have to register from Rupee 1. The good news, the whole process is digital. It's a 6-step online procedure on the GST portal. You verify your PAN and Aadhaar, and boom, you usually have your certificate within a week. But what if you're a small, local business? Say you're over the 40 lakh mark, but doing complex monthly accounting sounds like a literal nightmare. Enter the composition levy. If your turnover is under 1.5 crores, you can opt for this cleverly simplified scheme. Instead of constantly calculating inputs and outputs, our local grocery store owner just pays a flat 1% tax on their total turnover every quarter. The catch? You can't claim any input tax credit, and you can't collect tax from your customers on their invoice. It's basically a trade-off. Give up the ITC in exchange for pure peace of mind and dead simple compliance. Now, for the standard businesses that do want to claim that sweet, sweet input tax credit, maintaining a spotless paper trail is everything. It all kicks off with a valid tax invoice. If the price changes later on, you use standardized documents to keep it transparent. A debit note if the value goes up, or a credit note for things like sales returns. And all of this digital paperwork feeds directly into monthly returns, mainly GSTR 1 for your outward supplies and GSTR 3B for your overall monthly summary. And finally, Section 5. Let's do some real-world GST math and put all this theory into practice. Let's test this out with a pretty standard scenario. Imagine we've got a supplier sitting up in Delhi. They sell goods worth 1 lakh rupees to a buyer all the way down in Chennai. The GST rate for these particular goods is 12%. Based on those dual model rules we just talked about, which specific type of tax applies here and how exactly is it calculated? Take a second to think about it. All right, here's the solution. Because the supply originates in Delhi and terminates in Chennai, it crosses borders. That makes it an interstate supply. So CGST and SGST, they are completely nil. That entire 12% tax is levied as integrated GST or IGST, meaning the buyer gets invoiced for $1,12,000, and that $12,000 tax payment goes straight to the central government, who will later sort out the revenue sharing with Tamil Nadu. Let's try just one more, slightly different this time. A vendor in Bengaluru sells goods to a buyer who is also located right there in Bengaluru. The taxable value is 50,000 rupees, and the GST rate is 18%. Since the supplier and the buyer are in the exact same state, how does that 18% tax get collected? And here is where you really see the beautiful symmetry of India's dual model, because it's an intrastate supply staying within Karnataka. That 18% rate gets split perfectly down the middle. 9% goes to the center as CGST, which is 4,500 rupees, and the other 9% goes to the state as SGST, another 4,500 rupees, making the total invoice 59,000 rupees. Once you see the actual mechanics at work, it's remarkably logical, isn't it? And that, folks, brings us to the end of our deep dive. Former Finance Minister Arun Jaitley really hit the nail on the head when he said, GST is not just a tax reform, it is an economic transformation. By collapsing an absolute nightmare of fractured, cascading taxes into one digitally driven, unified network, GST quite literally redrew India's economic borders. And it leaves us with a really fascinating question to chew on. As our global economies become more and more interconnected,
Could this kind of unified, transparent, digital tax system eventually become the blueprint for all international trade? Definitely something to think about. Thank you so much for joining me on this explainer, and keep exploring the incredible mechanisms that power our world.